This is Barry Weber. I'm a CPA and attorney in the Fresno, California area, and I want to talk to you just a little bit about how to choose the best form of entity for your business. Now, while an entity can apply to a lot of different types of activities, for example, investment activities or real estate activities, this is really geared for an active business. And what this video intends to do is just to give you the basic information about the different choices of entity that you can make. It's only in the basic introduction. It's not intended to be legal advice or form an attorney-client relationship between you and me. And it's specific to businesses operating in California under California law. Now, there's several different types of entities that you can choose from. The sole proprietorship or Schedule C entity is the simplest. It's simply a person doing business under their own name or under a DBA, and it's simple to do. You report your income and loss on your personal tax return, and you only have one owner. Variation on that is a general partnership where it's simple. It shares a lot of the characteristics of the sole proprietorship, but there's more than one owner. A general partnership pays or files its own tax return, but it doesn't pay tax in a normal situation. Taxes flowed through to the individual partners on a Schedule K. We'll talk about that more in a later slide. A variation on the general partnership is a limited partnership. Now, the problem with a general partnership is it has the owners are unlimitedly liable for the acts of the partnership. But a limited partnership, you can have investment-only partners who don't share any responsibility for the management of the company, but are simply investors and are only at risk for their investment. A limited partnership has to have at least one general partner who is liable for the acts of the partnership. Now, all of these forms of entities have some liability to someone other than the entity. A corporation is the tried and true method of limiting liability, where the corporate acts are the obligations of the corporation and the shareholders are investors of the corporation. Now, there's two different types of corporations that can be filed under or formed under California law. There's a C corporation that files its own tax return and pays its own taxes, and an subchapter S corporation, which makes an election and files its own return, but then passes through most of the income and loss to the individual partners. A new form of entity is available in almost every state, but every state's rules are different, is the limited liability company, or LLC. A limited liability company has much the same characteristics as a corporation, but it's easy. It doesn't require the strict formalities of corporation. It has great flexibility as to how earnings of the entity are taxed, which we'll cover in a little while. But there are a few limitations as to the types of people that can own limited liability company interests. And California has carved out another type of entity called a limited liability partnership, specifically for professional people, for example, accountants, attorneys, doctors. We're really not going to cover much about limited liability partnerships. If you're one of those categories of people, you need to talk to your accountant and attorney. Now, the best time to make the choice of entity is when you're forming the corporation or forming the entity. You should sit down with your accountant and attorney and discuss where you're going, what kind of business you're going to have, what are the liability problems, what do you expect earnings and growth to be. And the easiest time to do that is before you actually organize the entity itself. But typically, most people that go into business don't do that. They start off as a sole proprietorship or a partnership if there's more than one person, and then some event occurs that causes them to rethink their unlimited liability. And you can change entity types, but then it becomes more difficult. You've got duplicate tax returns to file. You've got some tax considerations on the change. It's easier to do it when the entity's being formed, but it's doable at most every other time. Now, back to the first type, a sole proprietorship, as we discussed, is simple and easy. There's no state or federal filing required to organize the entity. There's no separate tax return to file. An owner or sole proprietor simply reports the income or loss of the business activity on his personal 1040 tax return. He adds a schedule. It's called a Schedule C entity, and that's because a Schedule C is added to the 1040 to report the income and loss. Sole proprietorship really doesn't even need a taxpayer identification number of its own unless it has employees. The Schedule C can report the income using the personal Social Security number of the owner. Now, there is a county filing requirement if the sole proprietorship or any other organization does business under what's called a doing business as, or a DBA. And in this case, you file a fictitious business name statement with the county. That's easy to do, requires a little bit of expense and publication, but it's not hard. The characteristics, the biggest problem of a sole proprietorship is there's no separation from the owner. The owner is completely liable for all the debts of the sole proprietorship, and the sole proprietorship's assets are on the hook for the individual owner. Now, again, a general partnership is much like a sole proprietorship, but you have two or more owners. There is an exception to that for a married couple who both actively participate in the business and file jointly. They can each file their Schedule Cs and attach it to the joint tax return and report their share of the partnership income on that Schedule C. Partnership can register with the state, but it's not required to. A partnership does file its own tax returns, but their information returns in most cases. The income and loss or loss of the corporation is passed through to the individual owners on a Schedule K and is reported by the individual owners and taxes paid by the owners or the partners. In a partnership, losses flow through to the individual owners with some limitations. There's issues regarding active participation, basis in the partnership interest, and the like that you need to discuss with your accountant. Again, if the partnership operates under a DBA, a fictitious business name statement is filed with the county. Like a sole proprietorship, all partners are liable for the partnership activities. And conversely, the liabilities of each partner extend to the other partner's acts in furtherance of the partnership. So, for example, if partner A incurs a debt on behalf of the partnership, partner B is liable for it. Again, we won't discuss much about a limited partnership other than the fact that it must have at least one general partner who manages the partnership, and the limited partnerships are typically have an investment or financial interest only. They have no management authority, and the limited partners are liable only to the extent of their investment in the partnership. So they can lose their investment, but they're not going to be liable for acts of the partnership. Limited liability partnerships are usually expensive to set up. For example, a written limited partnership agreement must be filed with the state and require the assistance of an attorney or an accountant. A C corporation is a separate entity for legal and tax purposes. It can have just one shareholder, so a sole proprietor can convert to a corporation and without an issue and pay taxes at the corporate level. The current tax rate on a C corporation is up to 35%, and that could change. There's legislation that's being proposed to significantly change the current tax rate, so you ought to pay attention to what's going on and revisit this issue once Congress makes a determination as to what to do. The problem with a C corporation is that there's no deductions at the corporate level for dividends paid to shareholders. So typically a corporation earns income, pays taxes, the income is distributed to shareholders, and the shareholders pay taxes on that income a second time. There are some special requirements or special rules for small corporations or small business corporations that are kind of beyond the scope of this conversation. But in general, a shareholder pays taxes on the income on the distributions from the corporation. There's forms to file and procedures to follow. For example, the corporation must file a business statement with the Secretary of State every 2 years and name an agent for service of process. But a corporation as a separate entity from its owner does not die with the owner. In a sole proprietorship, when the owner goes away, the proprietorship goes away. In a corporation, the corporation can exist on, and the shares merely pass however they're going to pass to a new owner. There's limited liability for the shareholders. If a corporation incurs a debt, in theory, the shareholder is not responsible for that debt. You should know that in the situation of most small corporations or closely held corporations, the banks or a lessor or a supplier can and will require a personal guarantee, so the debt, that limited liability for that debt doesn't go away. Shares of a corporation are easily transferred at death simply by assigning the share to another person. If a corporation, again, operates under other than its legal corporate name, a fictitious business name statement is required. And a corporation must use the words incorporated or corporation or their abbreviations in its name. The biggest limitation of a corporation is it requires the owners follow strict operational rules. There can be no commingling of funds. The accounts of the owner and the corporation must be kept completely separate. There's meetings that you have to have, and you need to have minutes of those meetings. And you are required to get board approval of any acts outside the normal business activities of the corporation. Organizational costs are higher with a corporation. An attorney must draft and file articles of incorporation and bylaws, and you need to follow the rules set down in the articles and bylaws. The owners in a corporation aren't owners of the assets directly, but they're shareholders of the corporation. The corporation is run by a board of directors that's elected by the shareholders and in turn elects officers to run the day-to-day operations of the business. The shareholders must elect a board every year at its required annual meeting. The corporation files its own tax return, and in the case of a Schedule C corporation, pays its own tax. As we discussed, there's a double taxation of dividends. In addition, California has a minimum franchise tax that is at least $800 or the percentage of income. There are special tax issues that you should be aware of if your corporation is a personal service corporation, a personal holding company, or if you hold excess accumulated earnings. These are all complicated issues that need to be discussed with your accountant and attorney if these issues apply. The losses of a corporation cannot be passed through to the shareholders in a Schedule C corporation, but the losses can be carried forward or back by the corporation to years in which the corporation had income. The owners of a corporation, who are also shareholders, are an employee and get a W-2 just like any other employee and pays their own taxes on salaries and wages, and again pays taxes on the dividends it receives from the corporation. But wages to the owner, in most cases, are deductible by the corporation. The owners of a corporation are insulated from the liabilities of a corporation. There's a couple of situations where it might be a problem in the case of payroll taxes, but the biggest problem with a corporation is not following the rules and creating alter ego problems. If somebody sues a corporation, especially a small corporation, the first thing they're going to do is to allege alter ego liability on its owners. And there is alter ego liability where there was commingling of funds, where the corporation was not following the corporate procedures, where the corporation was undercapitalized or set up to defraud creditors. So just remember that you need to follow the rules, and you need to set up your corporation properly to achieve limited liability from the corporation's activities. Now, a corporation, a C corporation, can make an election to be taxed as an S corp. The S corp is just like a C corp, but it's taxed like a partnership. There's a formal election that has to be made, and California again requires, even though the income from the S corp flows through to the shareholders, California imposes a franchise tax of the greater of $800 or 1.5% of net income. This S corporation still must follow strict operational rules like a C corporation, and there's restrictions on who can be a shareholder. For example, you can only have 100 shareholders. In most cases, they must all be natural persons, no non-resident aliens, and you can't have multiple classes of stock. Just as an aside, you can have differences in voting rights, but you can't have differences in allocation of income and loss between partners, between shareholders. But an S corp can pass losses through to shareholders with some limitations. The LLC is a relatively new form of entity, and each state now recognizes the limited liability corporate form, but all states are different as to what their operational and rules and benefits are. It's increasingly popular because it achieves creating a separate entity for legal liability purposes, but it also allows flexibility as to how taxes are paid. And it does not require the strict formalities be followed like a corporation. A LLC is easy to form. It can have just one member. A LLC can be taxed either as a disregarded entity in the case of a single member LLC, and in that case it's just taxed just like a sole proprietorship, or if there's more than one shareholder or a member in an LLC, it can be taxed as a partnership, or it can be taxed as a corporation. Now, if it's a corporation, it can either pay its own taxes, like a C corporation, or it can make an S corp election and still pass the tax benefits and liabilities through to the individual shareholder or the individual members, but it does allow for some flexibility where members or owners are also employees of the business. So in that case, a LLC can be taxed as a corporation and in turn make an S corp election where the employees can be, or the members can be employees of the corporation and be treated as W-2s and receive the benefits of any other employee. The LLC needs to have some sort of operating agreement, which, like the articles and bylaws of a corporation, are its rules of operation. In California, they need not even be written, but it's highly recommended that you have written operating instructions or operating agreement. The operating agreement is not filed with the state, and it should include things like the identification of members and what their interests are, what each person's capital contribution is, how the LLC is managed, and the powers of the manager, the rights of members and how the member rights are enforced, the allocation of profits and losses. Unlike a subchapter S corporation, you can allocate profits and losses in unequal measure as long as there's economic substance to the allocation. It's not for tax avoidance. The operating agreement should spell out what happens if there's a dissolution or a member withdraws. And you can also cover how disputes are settled between the members. For example, you can require that arbitration happen rather than going to court. If the operating agreement is either non-existent or doesn't apply to a particular issue, then the state provides statutory rules of operation, which may not be what you want to have happen. A LLC can be either member managed or manager managed. If it's manager managed, then that's like a corporation where you have a hired manager or a individual person takes on the management role and is liable for all the acts of the LLC. The manager is normally appointed in the operating agreement, or the method or the type of managers is determined in the operating agreement. And if it's member managed, that means the members themselves manage the corporation. So each member has a say in how the corporation or the LLC is managed. Now that can cause some problems where you have disagreement between the members as to particular issues, and deadlock can be a real issue. Just so you know, California does not allow many professional corporations or professional entities to form LLCs. So what's the best form? A sole proprietorship is relatively simple. It's appropriate where the business has few assets. The owner operates it by himself or with a spouse. The owner's not concerned about his personal liability for the business entity, and in a lot of cases where most of the income is paid out to the owner anyway. A partnership has a lot of those same concerns, but simply has more than one owner. A corporation can be the best entity where limited liability is a concern, but it requires that the shareholders can and will follow corporate formalities, or the separation of liability can be pierced. The tax, in terms of a corporation being taxed, you have two choices. You can be taxed as a C corporation, and that's usually where the majority of the income is being retained in the C corporation, and the marginal rate of the individual shareholders is greater than the corporate tax rate. It makes more sense to pay the taxes at the corporate level. But the corporation can also make an S-corp election, and where the marginal individual rates are lower than the corporate rate. Another situation that you might want to make an S-corp election, or where losses are expected in the first few years. As we discussed, in a C corporation, losses aren't passed through to the individual shareholders, but must be taken at the corporate level. In an S corporation, the shareholders, with some limitation, can deduct personally the losses of the corporation. A limited liability company can be the best choice where the owners either do not want to follow strict operating formalities of a corporation or cannot follow those strict formalities, but they still want limited liability. A limited liability company is easy to form. You can do it online. So what's the best form of entity for you? And as you can see, it all depends. In any case, There's lots of laws to follow regardless the form of business. For example, a sole proprietorship still has a lot of laws to follow for payroll liability, for other things that any other form of business must follow. Now, where you get more information, you can contact me. There's an offer on the side of your screen for a free consultation. You can contact me at any time. I'd be happy to talk to you in person or by phone. I do give a free introductory consultation, a half hour in person or by phone. You can go to my website, which has a lot more information, or you can simply contact your existing attorney or accountant. That's the end of this presentation. I hope to see you at future presentations, and thank you for attending.